Hey guys, Frank here and welcome back to the New Vision channel where we talk about all things real estate. In this week's video, we are going to continue the series on bookkeeping for a real estate rental business. Specifically, we are going to focus on the topic of reconciliation or bank reconciliation in your bookkeeping activities. First off, we're going to find out what it is, right? What is reconciliation? And why would you want to do it in the first place? Okay, so in order to find out its meaning, let's start out simply by looking at our trusted friend, Google over here. Just to find out what the word reconciliation means in itself. And as you can see here, reconciliation. Google Dictionary gives us a couple of meanings here. And I think the second one here is a bit closer to what we are interested in. Reconciliation is the action of making one view or belief compatible with another. Fortunately, even in this definition, there is another meaning over here to the right hand, which is a bit closer to what we mean in accounting or bookkeeping. And it says, reconciliation is the process of ensuring that two sets of records are in agreement. So, which two sets of records are we talking about here? It turns out your bookkeeping activities is really capturing the ins and outs of transactions in your business. And at the same time, there is a second set of records that is following these transactions. That's usually that of the bank. And as you can imagine, the bank is perhaps more in tune with what is happening in your business because after all, the money that comes in and goes out of your business oftentimes does so through the bank. So, the act of reconciliation is your effort in your bookkeeping activities to reconcile your records to those of the institution like the banks, which captures more of the reality of what's going on in your business. And that there's a chance you might make an error in your own records that doesn't reflect the reality that's happening in the bank itself. So the activity of reconciliation is to make sure that those two records match at some point in time. And why would you want to do this? How often would you want to do it? Again, it's you determine the frequency, right? Some businesses have enough volume to require a daily reconciliation. Some businesses don't have enough volume, and perhaps something like a month would be more reasonable. But whatever the case may be, the idea is at some point in time, you stop and you take stock of the transactions that have happened over that period, and you make sure that those two records are in agreement. That is what is called the reconciliation effort. Okay, so how would you go about doing this? So what you see here is your typical reconciliation report, which you see over here. And the starting point in the reconciliation effort is really, first off, looking at what does the bank's record say about the transaction in your business over that period in time. So I'm looking at one entity over here, and this is the bank account for a given period, for the period of December 1st all the way to December 31st, which is a month. And there are two key numbers that we want to focus on here. What is the bank balance at the start of that period, and what is the ending balance during that period? And in between those two numbers are the transactions that happened in your business during this month. And our goal with reconciliation is to make sure that all those transactions that we entered into our bookkeeping system will take us from the start of that period and hopefully should arrive at the same number at the end of that period. Should that be the case, then it's reasonable to conclude that at least numerically we are accurate. Okay, so in the reconciliation effort, the first thing we're going to do is going to tell, and by the way, most of this would happen in all bookkeeping systems that you might be using today. So this is something that is very software driven. Your job is really just to follow the numbers. So if we go to our reconciliation record that you see over here, the first thing that we did is tell our system, our reconciling system, what is the starting balance for the period that we are interested in. And as you can see here, it simply carries over the number that we have from the bank statement to our reconciling software. So we have that number over here. But before we go into the numbers, actually, let me just point out, again, you have most of bookkeeping, most of accounting often results in reports. This is like any other report you might generate in an accounting system. And there's, first of all, some biographical information that you want to cover. So as we said in the beginning, reconciliation is for a period, a start and an end. So you usually designate that somewhere in the report. You want to capture perhaps the date on which the reconciliation happened. You see that, and who did the reconciliation, because again, most of bookkeeping, most of accounting is following flows. So very often you want to find the parameters of that flow. When did it happen? Who did it? For what company and the like. So these are all biographical information about this reconciling process. Then we come back to what we started talking about, which is, okay, what is the starting balance for that period? And we simply copied what the bank statement said and over here. And then we can jump over all the transactions and we come over to the end here where we see the ending balance as stated by the bank account. So these are our bookends. These are the start and the end. And our goal is to make sure that numerically we agree in the middle. All the transactions that happen, and this you can see them down here, these are the transactions that we captured in our bookkeeping system. We want to make sure that numerically they add up. They are able to take us from the starting point as determined by the bank to the ending point as determined by the bank for this period of December 1st to December 31st, 2023. So what you see now is our list of transactions. And this is a formatted report, which means it's just, somebody decided that it should look a certain way. And so different softwares might have different things, but the basic pieces of information are usually the same. It's a list of transactions grouped in a certain way. In this instance, for example, we show here that over this period, we entered 29 transactions in our system, 29 transactions that were of the nature of an expense or an outgoing. In other words, you can see the numbers are negative over here. These are payments, these are monies that left the business and went somewhere out of the business. And down here, we show the incomings, right? These are revenue. This is money that came in from the outside into the business. And we show those, there were 20 of them we entered into our bookkeeping system over here. Okay, so the first thing, or one thing I should add, is that you would notice that these transactions don't have to match line for line as the banks. For example, just look at this number over here. We have 29 transactions that we physically entered into our system, and the bank, on the other hand, shows that there were 30 transactions that happen on the account with the nature of a withdrawal. So the numbers don't have to match, the number of transactions don't have to match, but the total have to. That's the whole idea of reconciliation, is that numerically the total sum of transactions do need to match over that period. Okay, so we come back to our reconciliation statement over here, and we see that between these two groups of transactions, we entered a total withdrawal of $31,080.91. Okay, these are all the monies that left the account over this period. And if you scroll down here, you see that equally we had deposits. We had monies coming into the account that totaled $36,324. I'm just going to highlight these two things here for future reference. Okay, so these are the totals of our incomings, or our outgoings, and our incomings. All right, so we just want to check that the total of these transactions will indeed guarantee the journey from the starting balance as seen by the bank to the ending balance as seen by the bank. And we can actually check that here. So I'm just going to bring up a quick calculator so that we can do the numbers and you can see what we are talking about here. So let's start off with our starting balance over here. Our starting balance was 15,323 and 17 cents. Okay, and if I scroll down here, you see that we withdrew from this account a total of $31,080 and 91 cents. So what we're going to do, we're going to subtract 31,080 and 91 cents. Okay, that gives us now a negative balance, but we have, of course, note that's just one aspect of the transactions. At the same time, over this period, there was a bunch of transactions that came in that were more of a revenue type. In other words, money going into the account, and the totality of this was $36,324.00. So when I make this sum, you can come back up here and you can see that we are indeed perfectly matching with what the bank sees as the transaction, or the bank saw, because remember, this is in the past. The bank saw that in this period they had an ending balance of $20,566.26. So we are in agreement. We are reconciled. Our records reconcile with those of the bank. And this is a happy outcome, okay? Because when you achieve this, here is the kicker. You've bought yourself two things. The first is you have now a very accurate sense of what happened in your business over this period. You can make decisions, you can make conclusions, you can make all kinds of decisions, basically, based on this number, right? It's an accurate reflection of what happened in your business. So, for example, many things can flow from here, cash flow decisions and all kinds of things. You can say, okay, this is the money that I have, this is what happened. Is this number according to my forecast? Is this number different from what I was expecting, and why? This is where the business owner or the business decision makers make decisions about their business. Your job as a bookkeeper is to simply show them accurately what that number is, and to make sure that it corresponds to the reality of what is in the bank. That is all a bookkeeper does. So it's a very simple activity. The second outcome from reconciling up to this point is that you've bought yourself, both the business owner and the bookkeeper, some freedom of what I call the tyranny of numbers, right? If you don't do bookkeeping well, or if you don't do it at all, not only are you going to be prone to have mistakes happen in your business that you don't know, but you have this burden of memory. You have to remember things from months and weeks and years ago because you don't have an accurate sense of where things are over this period. But when you reconcile your books, much as we've done here, you get to a point where you can forget about the past because those records are accurately captured in your system, right? And in fact, many of today's software will, as of this point, lock those transactions. In other words, you are not going to be allowed to change them, or at least not without a notification, right? It will tell you that those accounts have been, or those transactions have been reconciled, so you should not kind of mess around with them. And that's a good thing because it preserves the integrity of your system. It makes sure that, when things were correct in the past, if there were ever a mistake happening in the future, then you don't have to look so far back because you know that as of this date, your records were numerically accurate. And the last thing I'm going to comment about is that we are talking about numerical accuracy, okay? Numerical accuracy doesn't always mean factual accuracy. In other words, These numbers might match, but indeed there might still be errors in the transaction, because all these numbers are doing for reconciliation is just matching numbers, right? The transaction itself might still have an error. For example, if you made an error in allocating one tenant's rent to another, this will not catch that, okay? The numbers will still match up, but you would have actually entered an erroneous transaction. So in this instance, it does one thing for you, but not everything for you in terms of checking for factual accuracy. So, but nevertheless, numerical accuracy is very important, and this is what we've accomplished here with the process of reconciliation. So please let us know in the comments below if you enjoy this type of content. Don't hesitate to sign up to the channel. It really does help us to move the channel forward. And please don't forget to click the notification button so that you will know every time we put out a new video. Many thanks, and see you in the next video.